Let me start with a hard truth most people don't want to hear. Buying a house is not a dream, it's a financial decision. And if you get it wrong, it doesn't just slow you down, it chains you to decades of regret. Too many people are emotional with the biggest purchase of their lives, and emotion is the fastest way to lose money. In 2026, the housing market is not forgiving mistakes, it's punishing them. Here's the warning. There are 5 states where buying a house next year could be one of the worst financial moves you make, not because homes are ugly or neighborhoods are bad, but because the numbers are broken. When the math doesn't work, walk away. First, California. High prices, brutal taxes, insurance chaos, and population outflow. You're paying a premium to enter a market where demand is weakening and costs never stop rising. Property taxes, income taxes, regulations, and now insurance companies pulling out entirely. Appreciation used to save bad decisions here. That era is over. Second, New York. If you think buying property here is about prestige, you've already lost. High taxes, aging infrastructure, declining affordability, and net migration moving out. Rent control and regulations crush investor returns, and homeowners absorb the cost. You don't buy where policy fights wealth creation. Third, Illinois. This is a pension bomb waiting to explode. Massive unfunded liabilities mean higher taxes are inevitable. When governments are desperate, property owners become the target. Home prices stagnate, taxes rise, and liquidity dries up. That's not an investment, that's a trap. Fourth, New Jersey. It looks safe, it looks established, but property taxes here are some of the highest in the country, and they only move in one direction. When your carrying costs eat your appreciation, you're working for the house, not the other way around. Fifth, Florida, and this one surprises people. It's not about demand, it's about risk. Insurance costs are EXP, loading. Climate exposure, rising premiums, and shrinking coverage are changing the math fast. A cheap mortgage doesn't matter if your insurance doubles or disappears. Risk-adjusted returns matter more than hype. This isn't fear. It's discipline. Wealth isn't built by following crowds or headlines. It's built by protecting downside first. The smart move in 2026 is not asking, can I afford the say, it's asking, does this house protect my future? The winners are patient. They rent when ownership doesn't make sense. They buy where taxes are predictable, insurance is stable, and population is growing for the right reasons. They treat real estate like a business, not a lifestyle accessory. If you want financial freedom, stop romanticizing ownership and start respecting math, because houses don't make you rich. Good decisions do. Real estate is math, not emotion. If the numbers don't work, the house will drain you, no matter how good it looks. High taxes destroy long-term wealth. Appreciation can't save you when governments keep raising the bill. Insurance risk is the new hidden cost. A cheap mortgage means nothing if coverage disappears or premiums explode. Population and policy trends matter more than hype, people and capital moving. UT is a red flag, always follow the flow, protect downside before chasing upside. Wealth is built by avoiding bad deals, not by forcing ownership at the wrong time. Most people walk into real estate with their heart leading and their calculator trailing behind, and that's exactly how wealth leaks out quietly over time. They fall in love with countertops, neighborhoods, views, and status, and they convince themselves that if it feels right, the money will somehow work itself out. It never does. Real estate doesn't care how you feel. It only responds to numbers, and numbers are brutally honest. When you ignore them, you don't just make a bad purchase, you lock yourself into years of financial friction that compounds against you. The biggest lie people tell themselves is that buying a home is always a smart move. That belief alone has destroyed more balance sheets than market crashes ever could. Ownership is not automatically wealth building, it's conditional. It works only when the math supports it. And in many cases, especially during overheated or distorted markets, the math is screaming, don't do this, while emotions shout louder. When you buy based on emotion, you overpay. When you overpay, appreciation has to save you. And when appreciation slows, stops, or reverses, you're exposed. Start with the most basic equation, total cost versus total benefit. Not just the mortgage payment, but taxes, insurance, maintenance, opportunity costs, transaction fees, and risk. Most people conveniently forget half of these because they don't show up on the glossy listing photos. A house is a liability before it becomes an asset, and the transition only happens if the numbers align over time. If your carrying costs rise faster than your income or appreciation, the house owns you. Emotion is especially dangerous because it makes bad deals feel justified. People say things like, "It's for my family, it's a safe area," or "real estate always goes up." None of those statements pay he bills. Safety doesn't offset negative cash flow. Comfort doesn't cancel out rising taxes. And markets do not owe you appreciation just because you showed up. When interest rates, insurance costs, or local policies change, sentiment doesn't protect you. Math does. The disciplined buyer looks at real estate the same way a serious investor looks at a business. What is the return? What is the risk? What could go wrong? If the downside scenarios make you uncomfortable, you walk away. You don't negotiate with reality. You don't hope it improves. You move on. Renting, waiting, or choosing a different market is not failure. It's restraint, and restraint is a wealth skill. Another emotional trap is the idea of timing your life around ownership. People rush to buy because they think they're foul. Ling behind because someone else their age owns a house or because society tells them renting is wasted money. That pressure is noise. Renting can be the smartest financial decision when it preserves flexibility and capital. Capital gives you options. Bad real estate takes them away. The math-first mindset also forces you to acknowledge risk honestly. Job stability, market liquidity, local regulation, and long-term affordability matter more than vibes. If you wouldn't invest your savings into a business with shrinking margins and rising costs, why would you buy a house under the same conditions? Because it feels permanent? Permanence is not protection. Liquidity is, wealthy people don't avoid emotion because they're cold. They avoid it because it's expensive. They know every dollar tie. D-up in a poorly performing asset is a dollar not working elsewhere. They respect compounding, and they understand that small miscalculations repeated monthly over decades become massive losses. The house you stretch for today can quietly delay your freedom by 10 or 20 years. Real estate can be powerful when it's approached correctly. It can stabilize costs, create leverage, and build EQ. Equity over time. But those benefits are earned through discipline, not desire. The moment you justify a purchase with feelings instead of figures, you've crossed from strategy into speculation. And speculation dressed up as responsibility is still speculation. The smartest buyers are willing to disappoint their emotions to protect their future. They run the numbers again and again. They stress test assumptions. They accept that walking away from a deal that doesn't work is a win, not a loss. They don't need validation from ownership because they understand that wealth is built quietly, patiently, and often by saying no when everyone else is saying yes, while the math keeps doing what it always does, whether you respect it or not. High taxes don't arrive all at once. They creep in slowly, quietly, and relentlessly. And that's exactly why they are so dangerous to long-term wealth. Most buyers look at the purchase price and the monthly mortgage and think they've done the math. They haven't. Taxes are the silent partner in the deal, and unlike a mortgage, they don't get smaller over time. They grow, they compound, and they have no finish line. When taxes are high, every dollar you earn has to work harder just to stand still. Property taxes alone can erase years of appreciation, especially in states where governments are addicted to spending and short on discipline. You might see your home value rise on paper, but if your tax bill rises faster, your real return is shrinking. That's not progress. That's erosion disguised as growth. The problem gets worse when you combine property. Taxes with state and local income taxes. You're taxed when you earn, taxed when you own, and taxed when you sell. That triple hit changes the entire equation of ownership. People underestimate this because taxes don't feel like a choice. They feel inevitable, so they're ignored. But inevitability doesn't make them harmless. It makes them more dangerous because they're accepted without resistance. Governments rarely lower taxes. When they do, it's temporary and political. When they raise them, it's permanent. Pension obligations, healthcare costs, infrastructure decay, and debt servicing don't disappear. They get passed on to the most reliable payers, property owners, and high earners. If a state has massive unfunded liabilities buying property, there is a bet that politicians will suddenly become fiscally responsible. That's not a strategy, that's hope. High taxes also reduce flexibility. When your carrying costs are inflated, you lose the ability to adapt. A job change, a market slowdown, or an unexpected expense becomes harder to absorb. You can't easily rent out a property with high taxes and still break even. You can't sell quickly without taking a hit if buyers are factoring the same tax burden you're trying to escape. Liquidity disappears, and with it, options. Another overlooked effect is how taxes distort demand. As costs rise, buyers look elsewhere. Population shifts begin slowly, then accelerate. The people with the most mobility leave first, taking capital and productivity with them. What's left is a shrinking tax base supporting growing obligations. That's W. Then the pressure intensifies and the remaining property owners get squeezed even harder. It becomes a cycle that feeds on itself. Some argue that high-tax states offer better services, better schools, better infrastructure. Sometimes that's true, at least temporarily. But even the best services have a price ceiling beyond which they stop adding value. At a certain point, you're not paying for quality, you're paying for inefficiency. And inefficiency is a terrible investment. The disciplined approach is to evaluate taxes as a long-term drag on returns, not a fixed expense. Ask yourself what happens if they rise faster than inflation. Ask what happens if your income stalls but your tax bill doesn't. Ask whether appreciation can realistically outpace that burden over 20 or 30 years. If the answer relies on perfect conditions, it's not a good bet. Wealth grows where rules are predictable. Stability matters more than generosity. A moderate, stable tax environment beats a high, volatile one every time. You can plan around consistency. You can't plan around desperation. When states run out of room to maneuver, property owners become the release valve. The biggest mistake LeMake is assuming they'll be able to handle it later. Later is when it hurts the most, because by then, you're locked in. Selling is expensive. Moving is disruptive. And the taxes you ignored in the beginning are now baked into your lifestyle. High taxes don't just take money, they take time, freedom, and choice. And once they're embedded in a property decision, they don't go away, they just keep demanding their share every single year as long as your name is on the deed. Insurance used to be a footnote in the real estate conversation, a line item you glanced at, budgeted for, and moved on from. Those days are gone. Today, insurance is one of the most powerful forces reshaping the housing market, and ignoring it is one of the fastest ways to turn a seemingly affordable home into a financing. Liability. The danger isn't just higher premiums, it's uncertainty, and uncertainty is poison to long-term planning. Most buyers still think in terms of fixed cost. They lock in a mortgage and feel secure, believing they've controlled their biggest expense. What they don't realize is that insurance has become variable, volatile, and increasingly unpredictable. In certain markets, premiums are rising at double-digit rates year after year. In others, coverage is being reduced, restricted, or eliminated altogether. A low monthly payment means nothing if the cost of protecting the asset explodes without warning. The real risk isn't just paying more, it's losing access. When insurers pull out of a region, homeowners are forced into last resort policies with limited coverage and extreme PRI. At that point, you're not managing risk, you're absorbing it. One storm, one fire, one flood, and years of equity can vanish overnight. That's not theoretical. It's happening now, and it's accelerating. Insurance instability also affects property values, whether buyers want to admit it or not. A house that can't be insured affordably is a house with fewer buyers. Fewer buyers mean weaker demand. Weaker demand means pressure on prices. You may love your home, but the market doesn't care. When risk rises, prices adjust, often brutally. Liquidity disappears first and appreciation follows it down. Another overlooked factor is how insurance costs interact with financing. Lenders require coverage. When premiums spike, affordability calculations change, deals fall apart. Buyers qualify F or less. Sellers are forced to adjust expectations. What looked like a solid market on the surface starts cracking underneath. Insurance doesn't just protect homes. It underpins the entire housing ecosystem, and when it destabilizes, everything else feels it. Climate exposure is part of this story, but it's not the whole story. Regulation, litigation, rebuilding costs, and reinsurance markets all feed into premiums. Even well-maintained properties can become expensive to insure simply because of their location. Homeowners have no control over these macro forces, yet they're the ones paying for them. That imbalance matters. The disciplined buyer treats insurance as a core variable, not an afterthought. They stress test premiums the same way they stress test interest rates. They ask what pens if costs double. They ask whether the property still makes sense if coverage becomes harder to obtain. If the deal only works under perfect insurance conditions, it doesn't work at all. There's also a psychological trap at play. People assume tomorrow will look like today. They project current costs forward and call it a plan, but insurance markets don't move gradually. They reprice risk in jumps. A single year can undo a decade of assumptions. When that happens, homeowners don't have time to react. They're already committed. Wealth isn't just about returns, it's about resilience. A property that exposes you to unmanageable risk is not a smart asset. No matter how strong past appreciation looks, risk-adjusted returns matter more than raw numbers, especially in an environment where hawks are becoming more frequent and more expensive. Smart capital flows away from uncertainty and toward stability. When insurance becomes unreliable, capital follows. That's not panic, it's logic. The goal isn't to avoid all risk, that's impossible. The goal is to understand it, price it, and decide whether the reward is worth it. In many markets today, it isn't, and pretending otherwise doesn't. Change the math. It just delays the consequences until they arrive all at once and leave you dealing with a problem you thought you'd already solved. Markets don't move because of opinions. They move because of people, money, and rules. When any one of those starts drifting in the wrong direction, it shows up in the numbers long before it shows up in headlines. The mistake most buyers make is believing hype instead of data. They hear that an area is hot, booming, or the next big thing, and they stop asking the hard questions. Hype is easy. Trends require discipline. Population movement is one of the clearest signals in real estate, yet it's often ignored because it doesn't sound exciting. People vote with their feet. They move toward opportunity, affordability, and predictability, and they move away from high costs, heavy regulation, and shrinking prospects. When a state starts losing residents year after year, especially working age earners, that's not random, it's a warning. A shrinking or stagnant population puts pressure on everything. Housing demand weakens, tax bases narrow, governments respond by raising rates or adding fees to maintain revenue. That feeds the cycle, pushing even more people out. Property owners are left holding assets in markets where demand is slowly draining away. Prices don't always crash immediately. They stall first, then they underperform. That's how wealth quietly disappears. Policy plays an equal role. Laws, regulations, and taxes shape the environment in which property exists. When policy becomes hostile to ownership or investment, capital looks for friendlier ground. Rent controls, aggressive zoning restrictions, unpredictable tax changes, and complex compliance rules all increase. Risk raises costs, costs reduce returns. It's a simple chain reaction. The dangerous part is that policy damage often looks invisible at first. A new regulation doesn't make your house collapse. A tax increase doesn't force an immediate sale. The impact shows up over time, in lower buyer interest, slower appreciation, and reduced liquidity. By the time it's obvious, exiting is expensive. Hype thrives on short-term stories. A new development, a big employer announcement, or a temporary surge in demand can dominate attention. But trends are built on long-term behavior. Are people staying? Are businesses expanding sustainably or chasing incentives? Are local governments encouraging growth or suffocating it with red tape? These are the questions that matter, and they rarely make viral headlines. Smart buyers follow data, not noise. They look at net migration, job diversity, income growth, and business formation. They study how quickly permits are approved, how predictable tax policy is, and how often rules change. Stability beats excitement every time. A boring market with consistent growth will outperform a flashy one weighed down by policy risk. There's also a psychologue. ICAL bias at play. People want to believe their chosen location is special. They filter information to confirm that belief. When warning signs appear, they dismiss them as temporary or exaggerated. That's how people stay invested long after the fundamentals have shifted. Markets don't reward loyalty. They reward alignment with reality. Capital is ruthless and unemotional. It flows to places where it's treated well and leaves places where it's punished. When you see capital and talent moving out together, pay attention. That combination is hard to reverse and expensive to ignore. Real estate success isn't about predicting the future perfectly. It's about avoiding environments where the odds are stacked against you. Population decline and hostile policy tilt the table. You may still win OCC occasionally, but you're playing a harder game for lower rewards. Long-term wealth is built by positioning yourself where growth is supported, rules are clear, and demand is fueled by fundamentals, not slogans that sound good today but fade when the numbers stop backing them up. Most people think wealth is built by finding the next big win, the perfect deal, the highest upside. That mindset sounds exciting, but it's backward. Real wealth is built by avoiding catastrophic mistakes first. The people who stay rich aren't the ones who swing the hardest. They're the ones who protect themselves from losses that take years to recover from. In real estate, this principle matters more than anywhere else because the stakes are high and the exit costs are brutal. Downside risk is what kills momentum. Bad property doesn't just lose money, it consumes attention, energy, and options. It locks you into payments, maintenance, and stress, leaving less capital and focus for better opportunities. Even if the loss looks manageable on paper, the opportunity cost is massive. Time spent fixing a bad decision is time not spent compounding a good one. The mistake most buyers make is assuming they can handle. E-risk later. They focus on best-case scenarios and tell themselves they'll adjust if something goes wrong. But real estate doesn't adjust easily. Selling is slow. Refinancing depends on market conditions. Renting out a property depends on demand and regulations. When things go wrong, flexibility disappears, and that's when downside risk shows its teeth. Protecting downside starts with skepticism. Every assumption needs to be questioned. What if appreciation stalls for a decade? What if interest rates stay higher longer? What if taxes rise or insurance spikes? If the deal only works when everything goes right, it's not a deal, it's a gamble. Smart investors are allergic to gambles disguised as stability. Another overlooked danger is leverage. Leverage amplifies outcomes, good and bad. While it can accelerate gains, it can also magnify losses beyond what people expect. A small decline in value can wipe out years of equity when leverage is high. That's not pessimism, that's math. And math doesn't negotiate. Emotional attachment makes downside risk even worse. When people fall in love with a property, they ignore warning signs. They rationalize overpaying, they stretch budgets, they accept risks they wouldn't tolerate in any other investment. Emotion lowers standards, and lower standards invite problems. The disciplined approach is to treat every property as replaceable. If walking away feels painful, you're too attached. Cash flow is another form of protection. Properties that can support themselves offer resilience. Homes that rely entirely on appreciation are fragile. Appreciation is a bonus, not a guarantee. Markets can go sideways longer than people expect. When that happens, cash flow keeps you solvent and patient. Without it, every month becomes a test of endurance. The smartest buyers also plan their exit before they enter. They think about who the future buyer will be, what risks that buyer will care about, and how easy it will be to sell under less than ideal conditions. If the exit relies on optimism, cheap money, or perfect timing, it's weak. Strong exits are built on broad demand and manageable costs. Protecting downside doesn't mean avoiding all risk. It means choosing risks that are understandable, limited, and compensated. When risk is unlimited or unpredictable, no upside is worth it. This is especially true in markets distorted by policy, speculation, or hype. When prices outrun fundamentals, downside grows quietly in the background. Wealth compounds through survival. You don't need to win big if you never lose big, avoiding one bad real E. State decision can be more powerful than making several average ones. The goal isn't to impress anyone with bold moves. It's to build a structure that can withstand mistakes, market cycles, and uncertainty. When downside is controlled, upside has time to work, and time is the most powerful asset of all. This is about thinking long-term, acting rationally, and refusing to let pressure, hype, or fear dictate your biggest financial decisions. The market will always offer opportunities, but only to those who are patient enough to wait and disciplined enough to say no when the math is wrong. Ownership is powerful only when it serves your freedom, not when it compromises it. The people who win aren't louder or luckier. They're more selective, more prepared, and more willing to protect their futu. Before chasing growth, because in the end, wealth doesn't reward emotion, it rewards judgment.